how can I maximise the benefit to my children when I die? So this is the last section that generally talk about. There is this window of opportunity as you're in this phase before moving into retirement to maximise the benefit to your children. It doesn't often have much impact for you or your spouse, but there is a significant impact for your beneficiaries, particularly if that's adult children. Just had a question from Bruce. Sorry, Gavin, I missed how to get investment property sell-off into my pension stays fund. If you've gone down the track like we've talked about, you've sold your investment property, you've minimised the gain by either salary sacrificing to super or making a deductible contribution to your super fund, depending on whether you're employed or not. You've made those contributions to offset your tax, but you've still got, say, several $100,000 outside of super from the sale of the asset. Then that's when you can use your non-concessional contribution limit of it's $180,000 per annum, or if you're under 65, you can bring forward 2 other financial years contribution limits and put up to $540,000 into your super fund. So you've got to have the cash and then put that into your super fund. There is a rule restricting people who own investment properties in their own names, getting them into their super fund. That's something that's ruled out. The only scenario when you can do that is when it's business real property. So it's like a commercial property that it's an office or it's some other warehouse or something. You can move those into your super funds, and then you'd have to have it a self-managed super fund, but you can't move residential investment properties into your self-managed super fund. Hope that answers your question there, Bruce. How can I maximise the benefit to my children when I die? This really depends on the components of your superannuation fund. So generally your superannuation, the money you've got in your superannuation fund is made up of different types of contributions. So your 9.5% that your employer is putting in this financial year, it's called taxed components. Any salary sacrifice contributions is called a taxed components. Personal deductible contributions are core taxed components within your fund. What you've done by getting that money into your super fund is you've paid 15% tax on the way into the fund. And they're called concessional because generally you're paying less tax than if you had have paid income tax on that money. That's why it's called concessional. Now, these concessional contributions are called taxed elements, and those taxed elements, when they pass, say for example you die and they pass to non-financial dependents, so there's like adult children, then those components are taxed at 16.5% before they get the money. Now, post-tax contributions, like that money that you put in after you've paid tax on it, like we talked about with that investment property, you've sold the investment property, you've paid the tax on the capital gain, and you've still got $100,000 outside of super. If you put that $100,000 inside of super as a non-concessional contribution, that's called a post-tax contribution, non-concessional contribution, and that is defined within the fund as a tax-free element. And if those components transfer to a financial non-dependent on the event of your death, then they're tax-free. So the question is, how do you increase the tax-free elements and decrease the taxed elements? That's what we're just going to explain now.